Good evening. I'd like to welcome you to our third installment of our 6-Point Wealth educational series designed to empower you with the knowledge you need for sound financial planning. In our first session, we had ClearEstate cover Estate Planning 101, and in our second session, we covered the role of an executor, where we talked about the role of an executor and their responsibilities, the profile of an ideal executor and what to avoid when choosing one, real-life case studies demonstrating the impact your executor can have on your estate, and the benefits of naming a professional executor, and why you should consider one and what options are available to you. For those of you that missed the last two webinars, we do have it posted to our YouTube channel. And after this webinar, we will email you a recording of this session, as well as a link to our previous webinars. Today, we have ClearEstate again with us. They are our estate planning partner, and they're going to shine a light today specifically on death and taxes. From ClearEstate, we have with us again Ellie Muir, our key account manager, and she is our relationship manager and our first line of contact at ClearEstate. Today's webinar is also going to be led by Dana Charlebois. She's the manager of Estate Solutions, and she has extensive knowledge and experience in estate planning and settlement and is a trust and estate planning practitioner and certified estate specialist. We believe having a comprehensive estate plan is one of the most valuable gifts you can give your loved ones. Thoughtful planning not only ensures that your wishes will be honored, but it will also result in a significant time and financial savings and greatly reduce stress on your loved ones when the time does come. What we do know for certain is that we will all need to deal with death and taxes. So in today's webinar, we're going to learn about taxation on death, and we're going to share some important estate planning considerations that you should keep in mind. What we're going to cover is how your estate is taxed, how your assets are taxed, and how your spouse and beneficiaries are taxed, and then strategies for that tax-efficient wealth transfer. So at this point, I'm going to hand it over to Ellie to get us started.
Thanks so much, Mike. It's great to be joined by you and John, and I assume Carmela's here somewhere, as well as all of your clients on this Wednesday evening. We were just joking. What an amazing turnout to talk about death and taxes, but as you were saying, it's something that your clients are interested in learning more about, and Dana's going to be the person to take us through. So it's a pretty interesting webinar. As the old adage goes, there's only two things certain in life, and we're happy you're here to learn a bit more about them. Dana, I'll throw it over to you to get us started.
Awesome. Thank you. So thank you so much, Mike, John, and Ellie. I'm very happy to be here tonight, and I'm very honored that you all showed up to listen to me tonight to talk about death and taxes. So taxation on death is something that we probably get the most questions about. And so I hope today we can give you an overview and a bit more of an understanding of the subject, because I know it's not always very straightforward, and I know it's a heavy topic. So a little bit about me. I am the manager of estate solutions at ClearEstate. I've been with ClearEstate for over 2 years now, and I've been helping families with estate settlement for almost a decade. I've seen a lot, I've learned a lot, I'm still learning new things absolutely every day, which is why I love my job so much. And I have so much experience. So anything that I say from a personal perspective, it's something that I've actually experienced. And all of the problems that I'm going to talk about today, and all of the everything about tax, it's from personal experience as well. And I've seen these things go very, very wrong. So my goal in these webinars is always to help make things more simple and offer practical guidance in these webinars. I know the subject matter of death and taxes, or just death or just tax, is really, really heavy. So hopefully I can break it down in a more approachable way for you. So in case those attending don't know that much about ClearEstate, sorry, I'm going to go back one slide. Essentially, we're a one-stop shop for all things estate planning and settlement. We've developed a platform, which is essentially a technology to help make the process super efficient and help move people through the process in a way that empowers them to actually understand the process and make decisions confidently. In terms of what you're going to learn today, as I mentioned, of course, we're talking about taxation on death. I do think that you know that with this topic, you can get super granular, and we could probably do a whole separate webinar on all the different kinds of tax considerations that there are. But what we're trying to do today is to give you a bit of an overview of the things that you need to think about and understand as they relate to your estate plan, and to address those issues. So the first thing that I want to start with today is talking a little bit about probate. I'm sure you've all heard the word, but it's very difficult to discuss estate planning without talking about probate, and as well as estate settlement. So I think it's really important to get into a little bit. In the context of thinking about taxation, we must understand what probate is, what it means, and how it impacts your estate settlement. Often you hear about strategies to avoid probate and probate fees. Sometimes people will mention probate planning, or you'll hear all kinds of different suggestions for how to avoid probate, and that type of thing. And there's a couple of reasons why someone may want to avoid probate. One of the reasons is that it takes time to go through the process. It's quite a lengthy process. And the other reason is that there's typically a fee associated with obtaining probate. So the court often has a fee. Each province has different fees, and we'll get into that a little bit later. Now, what probate actually is it's a court process where the will, if there is one, and the authority of the estate representative, your executor, if you've appointed one in your will, is validated by the court. So it's the court's stamp of approval that you are the executor and you have the authority to do what you need to do. The proof that the executor receives is, in Ontario, it's called a certificate of appointment or a grant of probate, and the court gives this to the executor after they've reviewed all the information that's submitted. The documentation is what the executor can take to third parties and say, here's my proof that I'm the person with authority over this estate, and you can accept instructions from me. So that's generally what third parties like banks, and in other financial institutions, insurance companies, that type of stuff, they will require probate. So the next question typically is, when exactly do you need probate and what does it apply to? Basically, any third party that may be involved in your estate and has custody over your assets. So for example, your bank that holds your bank account, your investment firm that holds your investment account, perhaps the land titles office that is in control of the actual title of your home. They are the ones who have the right to require probate before they'll accept instructions from the executor. So the question then becomes, when your executor goes to deal with your estate, who are the third parties that they're going to have to deal with, and are they going to require probate? So as I mentioned, most jurisdictions impose some type of probate fee or probate tax. It's actually called, in Ontario, an estate administration tax. And now sometimes the terms are used interchangeably, which is important to understand that probate fees or estate administration tax are separate from income tax. They're very different. So I'll go into a little bit more detail on what assets are typically subject to probate, just so that we understand that piece and what's typically not subject to probate. So you can see here that we've described real estate that's held in your name or as tenants in common. In other words, you co-own it jointly with others, and you each have your own respective interest in the property. You can deduct mortgages when you're applying for probate, but that is basically the only expense that you are able to deduct for the purpose of probate fees. So every other liability is not applicable. It's only a mortgage that can be deducted from the full amount of your estate. Any bank accounts or non-registered investment accounts where these are held in your sole name or they are joint for convenience purposes, which is a terminology that we use to refer to when you've added an adult child to a bank account, but it's not with the right of survivorship. So that would be considered joint for convenience bank account. And reasons that you would add a child to a bank account and not have it joint with the right of survivorship is, again, for convenience purposes. So, maybe you're not mobile and you need them to go to the bank and do things for you, or you need them to take out money for you, that type of thing, and do transactions through your account. As well, personal effects and vehicles. And I say with exceptions, and I'm going to explain that in a little bit more detail in the next slide. But ultimately, if you need to transfer a vehicle and you have instructions under the will, in most cases, you can actually go to the government agency or the DMB and transfer the vehicle. However, what's important to know about probate is that as soon as you have to obtain probate for one asset in the estate, for any reason, in the estate settlement, you have to declare all of the assets. So what that means is if you need probate for a bank account, let's say, and there's also a vehicle in the estate, you'll need to declare the value of the vehicle as well as the bank account. And again, it would potentially be subject to probate fees, even though you don't need probate to transfer it. So once you're applying for probate, you have to give information about all of your assets, regardless of whether you need probate to transfer them, but there are some exceptions as well. So we'll get into that. Business interests are the same thing. If you own shares of a privately held corporation, you hold those in your individual name. They'll typically be subject to probate. I'm going to describe an exception to that on the next slide. Also included in probate are any of your registered plans that don't have a named beneficiary, or that you've named your estate as the beneficiary. Also, if there are personal loans or a promissory note that are owed to you, that would typically be subject to probate as well. Assets that are not typically subject to probate are anything that is held jointly with the right of survivorship. So with real estate that's held as joint tenants, we see this quite commonly between spouses with the right of survivorship. Same goes for investment accounts. So eligible assets under a secondary will, this is only applicable in some jurisdictions, and Ontario is one of them. So Ontario does accept secondary wills. So if you had significant assets like shares of a private company or personal effects that were extremely valuable, you could actually create a separate will to deal with those that wouldn't go through the probate process. So you would have a primary will and you'd have a secondary will. Only the primary will would go through the probate process. So that's a really good potential strategy that can help alleviate some probate fees if it makes sense for your particular situation. And again, it only applies in certain situations and to certain assets. Also, I mentioned here about the first dealings exemption, which is a very rare exemption available for real estate that has never been transferred on the land title system. However, it's exceedingly rare that a property qualifies for this anymore, since the land title system has been implemented for quite some time now, but it does still come up every once in a while. Life insurance and pensions that have been designated to beneficiaries are not subject to probate, and the same goes for registered plans you have. And then there are also assets held in an inter vivos trust, and an inter vivos trust is a trust that you create during your lifetime, and assets are held in that trust, so that you usually create that trust to avoid probate, and for certain other reasons. I'm not going to get too much into it, but assets held in that trust would not be subject to probate fees. They would bypass probate. Again, I'm not going to get into details on, why somebody might create that type of trust, because it's a bit beyond the scope of this presentation, and it could be a whole other presentation. But I just wanted to mention it there to be complete. Okay, so now that we have a fundamental understanding of probate and why it's needed, and a general description of what assets would be subject to probate and what might not be subject to probate, it's important to understand how probate fees actually might be calculated. The slide is talking about some of the different probate fees depending on the jurisdiction. So as you can see, it's a big range. Most jurisdictions have some type of tiered system where they actually charge based on a certain level of assets, and will charge a set amount. And then with a higher level of assets, it's another percentage that might apply. Some jurisdictions have flat fees. It just depends on the jurisdiction. And as you can see here, and as I scroll, there's a lot of variety. In Ontario specifically, it's, as I mentioned before, it's called estate administration tax. So the probate fees are called estate administration tax. And they describe it the way that I've outlined. Right here. So it's $15 for every $1,000 of assets over $50,000, also known as 1.5%. In some jurisdictions, there are no probate fees at all, so it really does vary a lot. But Ontario has some of the highest probate fees in Canada. Okay, As part of the estate settlement, people often ask, is probate always required if there's very little assets in the estate? So sometimes, depending on the situation, probate may not actually be required, in which case there wouldn't be any probate fees applicable. It always goes back to when the executor goes to deal with the assets, are third parties going to require probate? And then if the parties do require it, you have to identify which assets form part of the estate, and then probate fees are assessed on that. So anything passing through the estate would be subject to probate fees, and anything that kind of goes outside of the estate. So for example, something I talked about was an RRSP with a named beneficiary that would pass outside of the estate and would not be subject to probate fees. Moving on to income tax separately, here we talk a little bit about the deemed disposition of assets on death. You are going to hear me say the words deemed disposition many times tonight, so bear with me. Basically, what a deemed disposition means is that from a CRA perspective, on the day that you die, it's as if you sold everything you owned. So that does, of course, potentially trigger capital gains tax if there's an increase in value between the purchase price, which is also referred to as the cost base, and the date of death value. So if the price you purchased it for, if there's been an increase at date of death from the day that you purchased it, there's of course a capital gain. So if there's growth, then it's capital gain, and it's typically capital gains are taxed 50%. So 50% of the gain would be considered taxable income in your year of death. And I'll talk a little bit more about the specific tax returns in just a minute. The exception for this is where assets are going to a surviving spouse, in which case they can be rolled over at the original cost base, providing that the executor and the spouse jointly elect to do so. So that has to be done on the tax return. I think it's important to understand that the election has to be made, and the surviving spouse has some control over that as well, if they want it to be made or not. So it's something that really requires someone with knowledge to identify this and then to actually make the election. Okay, to talk a little bit about how we're actually reporting income at the time of your death, I wanted to share with you what tax returns might be involved. It really is the responsibility of the executor of your estate to work through this and actually assess things that determine your tax liabilities and file the returns correctly. And I would hope that they would consider getting professional guidance and support with doing that, since it is quite complex and it's not necessarily the same as when you file your T1 while you're alive. There are some considerations that are a bit different than your typical tax return, and I described them a little bit on this slide. So if there's any prior year tax returns that have not been filed, either because of the timing of someone's passing, or they just hadn't been filed because they were already overdue, then those would be required to be filed. And any usual taxable income or events for those periods would be included in those tax returns. And it's the responsibility of your executor to identify that they haven't been filed and to file them. In the year of death, we refer to the tax return as the terminal return or the T1D. And the T1D is for the period of January 1st until the date of your death in the year of death. And it would include any of the typical tax events that would occur, and it would include income up to the date of your death. It also includes the result of the deemed disposition that I previously talked about of all the assets on your death. So if you have capital gains that are triggered as a result of the deemed disposition, and that is regardless of what actually happens with the asset, unless it's rolled over to a spouse, this would be included in the terminal return. Sometimes this can result in a significant tax liability that's payable by your estate because of the deemed disposition on death. I've seen estates be kind of eaten by this T1D tax liability without proper planning, and it's just sometimes the tax liability is so large. Okay, now there are also a couple of optional returns that your executor would need to consider if it's beneficial to do those returns, depending on the type of income that there is to be reported. You may have a tax advantage of preparing these extra optional returns, and then you have your finally, your estate tax return, which is for the period after date of death and for any 12-month period that continues after. So any income earned after your death. The T3 estate return reports income earned in your estate after you pass away, but before assets are distributed. Now, I'm going to talk about each individual type of asset. We don't have time to cover every possible asset, but I've tried to cover most of the ones that would maybe be applicable to you. We're going to talk about the tax implications of each asset and the probate implications as well. So for real property, for your principal residence, there is a capital gains exemption available for the period of time that you ordinarily occupy a property as your principal residence. You can only have one principal residence at a time per family unit, which your family unit is your immediate family. If you own your property and you live in it, and you've lived in it the entire time that you've owned it, and you haven't owned any other property during that time, it's treated as your principal residence automatically when you sell it or upon your passing. And even with the deemed disposition that happens on death, there's going to be no resulting tax liability. The principal residence exemption will exempt it from any capital gains, which is a really, really big advantage that we have in Canada. The property no longer qualifies for the principal residence exemption unless the beneficiary of the property actually lives there and treats it as their principal residence. So any increase in value from date of death until when the property is actually sold or transferred, that would be subject to capital gains tax, and that would be payable by your estate, and the income would be declared in the T3 tax return or the estate return. So it's important to understand that because in the context of real estate, depending on the real estate markets, property value sometimes can change quite quickly. So that can potentially have a big impact. Now, if the property is held in your sole name or as tenants in common, then you own a respective share of the property, and probate fees would typically apply because you need probate in order to transfer the property. I mentioned here that co-ownership may affect access to principal residence exemption because I tend to get a lot of questions regarding co-ownership of property with adult children. So lots of people consider doing that, making their child co-owner as a way to avoid having that asset form part of your estate upon your passing. But there are implications to doing that, and I think it's important to note them. So not only are there tax implications, but there's also risk implications to you. So of course, if you co-own a property. So first we'll start with the tax implications. If you co-own a property with somebody who's not your spouse, there's a deemed disposition once you add them to the title of the property for their respective share that you've added them for. So there could be a potential tax implications there. If the principal residence exemption applies, then perhaps it's not as important, but you should know that the principal residence exemption, unless that co-owner also lives with you and it's also their principal residence, you may not qualify for the principal residence exemption. So you've maybe created a problem there that you wouldn't have otherwise had before, or tax payable that maybe wouldn't have been payable otherwise. So just careful planning.
One little question while you're on this slide, Dana. It's from Carmela, so I'm just going to pop it in now, okay?
Yeah.
She's asking if a principal residence goes down in value after death, before it's sold,
Okay.
does the individual get to claim a capital loss?
I'm gonna say off the top of my head, I believe so, but let's Ellie, let's write that down and get a definitive answer. But I do believe so. Don't quote me on that. We're gonna get a better answer later.
Will do. Okay, thank you.
Thank you. Okay, where was I? Okay, the other thing is that when you co-own any type of property with someone, there's always a risk that you've exposed that asset to the other person's creditors. So generally speaking, I think it's really important to think carefully about doing something like that. So before adding kind of anyone as a co-owner for convenience purposes or because you want to avoid probate, just look into all the potential risk and tax implications there. Now, let's talk a little bit about a recreational or income property. So basically any type of second property that you may own that's not considered your principal residence. So again, due to the deemed disposition on death, if there's an increase in value between your purchase price and the value as at the date of your death, this triggers a capital gain. And the resulting tax liability is reported on your terminal tax return, the T1D, and it's payable from your estate assets. So often we see problems arise with these types of property when there's an expectation that you're going to transfer that property to a beneficiary. But because you've triggered the gain and the tax liability has to be paid from somewhere, and maybe you don't have the cash on hand, your estate might not be big enough to handle the deemed disposition and the capital gain that results, you may have to sell that property, and that may not have been your intention. This is common with cottage properties, an issue that should really be thought through carefully and properly planned for. Also, if you have done any capital improvements to the property, you should keep those receipts because those can be used against the capital gain that may be payable on the deemed disposition. If the property is rented, rental income would be taxable and rental expenses could be used against income as usual. If the property is held in your sole name or as tenants in common, just as with property that's your principal residence, probate fees would typically apply. If you own the property jointly with the right of survivorship, typically the surviving owner just takes over the property when you pass and no probate fees apply. So it kind of just passes over to them. They would, for example, with a bank account, go to the bank, say, can you please remove the name? Here's the death certificate. They would remove the name. It would be your account. It's when the property is titled as tenants in common or in your sole name that probate fees would typically apply. So now we'll move into financial accounts, which any bank accounts, loans, promissory notes that are going to you. If there's interest earned in a savings account or if there's interest on personal loans, this is all considered taxable income up to the date of your death as usual and after date of death. Again, if there's further interest earned after death, then it would be taxable in your estate. Now, again, if the bank account is held in your sole name or it's considered to be joint for convenience purposes, these assets will also typically be subject to probate fees. I'm just going to highlight here that when you have a bank account where you've added your adult child to it, there's actually may be a presumption under the law that this is joint for convenience, like it's a joint for convenience account. So if you intend it any other way, that should be properly and carefully documented with the bank, because it's worth noting that not all financial institutions will ensure that it's done. So it's ultimately up to you to tell the financial institution what your intentions are. So my intentions are that this bank account go to my son after death. So I'm adding him because I want him to have the account after death, or I'm adding him for convenience purposes and I actually want it to form part of my estate. So being clear about those things and making sure that the paperwork is done right at the bank is important when you're adding adult children to your bank accounts. If you want there to be a right of survivorship, then that needs to be clear. And of course, you should also know that the risk that if there is a right of survivorship, that when you pass away, this account is now the surviving owners. And while you may have told them or imposed an obligation on them about what to do with the funds when you pass away, they don't actually have a legal obligation to follow that. So for example, if you made your main bank account joint with your adult child and you tell them, on my death, I expect that you're going to use this for estate expenses for my funeral, and then you're going to split the balance with the rest of your siblings. They may have a moral obligation because it was your wishes to do so, but they don't necessarily have a legal obligation to do so. So it's important to think through that type of asset ownership structure carefully when you're planning your estate. Now, non-registered investment accounts, in these types of accounts where you'd hold securities, any interest or dividends or capital gains earned or realized up to the date of death would be taxed as usual and would be part of your terminal T1 return. And then on death, if there are any unrealized capital gains, these would be realized because of that deemed disposition, unless they're rolling over to a spouse. The resulting tax liability would be payable by the estate, and any further income and growth would be taxable in the estate on the T3 tax return. So you can see a recurring theme here in terms of how the deemed disposition actually impacts each type of account that you have. Okay, a tax-free savings account. We're going to spend a little bit of time talking about that. Registered plans and tax-free savings account tend to have a lot of confusion around what they are and how you can distribute them and the different types of ways that you can name beneficiaries. It's something that I think a lot of people are confused about and could use some clarity. So tax-free savings accounts really truly are designed to be tax-free vehicles. So any income that's earned up until the date of your death is earned tax-free. If you and of course there are contribution limits. If you have a spouse, you can name them as your successor holder on the account. Now, only a spouse can be a successor holder, and what that does is when you pass away, they essentially step into your shoes and take over the TFSA and continue to grow it tax-free like it's their own. And it also doesn't impact their own contribution room to their own TFSA, which is a big advantage. If you've named a beneficiary, and this includes your spouse, they will receive the funds from your TFSA, and any income that's earned after the date of death will be taxed in that beneficiary's hands. So they receive the funds, of course, tax-free, but any income earned between the date of your death, then that will be taxed in their hands. So they will actually pay the tax on that. They'll have to claim it on their tax return. Now, if a spouse is named in this way, as a beneficiary, as opposed to a successor holder, there's still a rollover period that they can contribute the funds to their own TFSA without affecting their contribution room. However, the income earned between the date of death and the date when that makes it back into their TFSA is considered taxable income. And I'm going to give you a bit of a tip here, because you might assume that you've named your spouse as the successor holder of your TFSA. However, when TFSAs were first introduced, it wasn't possible to name a successor holder. You could only name a beneficiary. So if you set up your TFSA many, many years ago and have never kind of revisited who your beneficiary is or how that's structured, you may want to check and see if your spouse is your successor holder versus a beneficiary, because there may be some benefits there. So it's worth looking into if you've never revisited that. If your spouse is the successor holder, that's hard to say, they'll just take over the account and there will be no tax impact whatsoever. But if they're a beneficiary, they could take the funds and contribute them to their own TFSA during that rollover period. But there's more administrative steps involved in that. And there will become a period of time when the income does become taxable if they don't do it within a certain time frame. If you have named your estate as your beneficiary on your TFSA, or you have not named a beneficiary, or there's no beneficiary that you've named that survived you, then that asset would form part of your estate and would typically be subject to probate fees. And again, income earned after the date of death would be taxed in the estate or in the beneficiary's hands, depending if there's a beneficiary or not. Now, moving on to registered retirement savings plans. These accounts are essentially tax deferral vehicles, and how these work is that you make contributions and then you use those contributions to offset your income. Down the road, when you withdraw funds in your retirement, presumably you'll be in a lower income bracket, and you're achieving a lesser overall tax burden. But that means that you have to remember that any withdrawal from an RRSP, including upon your death, the entire amount is actually treated as income and it's taxable at that time unless it's going to a spouse. So same principle with the rollover as the TFSA. However, a much bigger tax impact with an RRSP because of the contribution receipts and the use of them to offset the income. Going back to RRSPs, regardless of whether there's a named beneficiary, unless it's a rollover to your spouse, the deemed disposition, it's as if you sold your entire RRSP, and that tax liability is payable from your estate assets, which I've often seen a very, very large tax liability because of an RRSP deemed disposition. So something to think about. And now a registered retirement income fund. So of course, these are sort of a continuation of your registered savings plan. So you must convert your RRSP to a RIF in the year that you turn 71, and you can no longer contribute to it at that point, and you are now required to withdraw minimum amounts. This is essentially the government's way of helping you spread out the tax liability during your retirement years. Now, if you make your spouse the successor holder, and then they take over your RRSP, they step into your shoes and there's no tax impact at that time, or sorry, your RIF. If you name another individual or organization, then they'll receive the full amount as taxable income. And like I just mentioned, the tax liability is payable by your estate. Again, if no beneficiary survives you or your estate is the named beneficiary, these funds could be subject to probate fees. Locked in retirement accounts are not significantly different from RRSPs. The main difference, of course, is that they are associated with a pension plan, and the withdrawals cannot be made until you either retire or pass away. When you do pass away, the funds can be, again, rolled over to a spouse's plan without impacting their contribution room, and in which case there would be no tax impact. But if a cash amount is taken from them in the absence of a rollover, then the tax liability is payable, again, by your estate, as with other registered plans. So now we'll talk a little bit about life insurance. Death benefit is not subject to income tax. However, if the death benefit is actually payable to your estate, either because you've named your estate as the beneficiary, or you failed to name a beneficiary, or you've named a beneficiary that has actually predeceased you, then it typically will be subject to probate fees. And on that topic, with respects to when you're naming beneficiaries, some institutions will allow you to name what we refer to as contingent beneficiaries, which means that it's an alternate beneficiary to the individual that you first named. Some institutions will only allow one layer of beneficiaries, and other institutions will allow contingent beneficiaries. So you can name your wife, and if your wife has predeceased you, then you can name your children as contingent beneficiaries, for example, which is always a really good planning tool to name contingent beneficiaries, just in case something happens to your first beneficiary. Because if you don't name a contingent beneficiary, then and your beneficiary predeceases you, the funds will fall to your estate and they'll be subject to probate fees. Typically with registered plans and life insurance policies, you can't get too fancy with your contingency planning on the forms themselves, but you could sometimes create a separate testamentary document, kind of like a trust declaration, to dictate how you want the funds to be handled in a contingency situation, or if you want the funds to essentially avoid probate but then flow through to a trust that you want to have for your children, for example. So just some complicated planning there, but could have some really important benefits. So there's ways to go about doing that, but it depends on whether the financial institution will accept it. And of course, it's a little bit of work to set up and to actually turn your mind to. But it's definitely important to think about contingent beneficiaries, so as to be as efficient as possible with your estate plan. Pensions. If you do have any type of pension, the benefits that are received, they would be taxed as usual. And if there are overpayments because you passed away and now you're no longer eligible, and your employer had continued to make automatic payments into your bank account, that would be expected to be paid back by your estate. So your executor would have to review the transactions in your bank accounts and make sure that the payments are returned to your pension provider. So you are entitled to, usually you are entitled to your pension payment for the month of death, and you are entitled to CPP and OAS for the month of death, regardless of when you passed away in that month. So it's always, as a pro tip, something I've seen a lot is people running to the bank to say, you know, my parent has died, and then what they do is they freeze the accounts. But normally you want to wait until the end of the month so that all the payments that are eligible for the deceased go into the bank account before you actually freeze the account, and nothing else can go in or out. Okay, a CPP death benefit, these are considered income, but there are other death benefits that may be exempt up to a certain threshold from being treated as income. And of course, if your surviving spouse receives your pension income, then that's typically considered taxable income in their hands as they receive it. Okay. I don't want to go into too much detail on this because it could be a whole other webinar. But if you were to create a living trust, also known as an inter vivos trust, which I talked about earlier, you could have these assets held in such a trust, which oftentimes is done for probate planning purposes, probate savings, and some other purposes as well. But assets in an inter vivos trust are not they do not form part of your estate, and they are not subject to probate fees. However, depending on the structure of the trust, it could be that there's still a deemed disposition of assets upon your death, in which case there could be taxable capital gains that would potentially apply. So personal effects and vehicles. Again, if you do need to apply for probate for any reason, typically you also have to include personal effects and vehicles as part of the value of your estate. I do get asked quite often, do I really have to include the value of personal effects in a probate application? And the reality is that the court has the ability or the right to question what you've reported on the probate application. And it's also very important to note that there's a liability on the executor to report information correctly. So if they're excluding information, so for example, there's a jewelry collection or an expensive painting collection, or even just household items that may have a value, if they fail to put that on the probate application, they're kind of breaching their duties there. I would say that if you were, for example, to report any real estate on a probate application, but then not report personal effects, the court may question, okay, well, this person owned, a 3-bedroom home and they lived there, so how could there be no personal effects inside of it? So the court does have the ability to question that. I've never seen it personally, but they certainly have that right. So it's something that you're expected to include in a probate application. Typically, the executor would look to get an appraisal of things like real estate and personal effects in order to determine the value. And the value should be the fair market value as at the date of death, and so not the replacement value. So it's always the date of death value, and it's always the fair market value. So typically it may not be a significant value, but technically it does need to be included in the probate application. Now, in terms of income tax, just like any other asset, there is a deemed disposition on death. And so there's an increase in value of the asset. There could be taxable capital gains. Now, this would only really apply on something highly valuable. So it wouldn't be your couch and your rug and that type of stuff. It would be valuable things like jewelry, artwork, collectibles, that type of stuff. So there could be a gain there. Vehicles depreciate basically immediately. So typically there's not a gain associated there, but it's important to note that there could be both probate fees and taxable capital gains associated with personal effects in general. I'm going to talk a little bit about private company shares because I do believe that there tends to be a lot of confusion around this one. It's not straightforward by any means. If you do happen to own shares of a private company, perhaps you have an incorporated business and you've retired and now it's a holding company and you continue to hold those shares, it's important to know that the date of death value of those shares would be considered part of your estate. You may have other family members that have shares in your corporation or just other people in general that have shares. However, your specific shares that you own would form part of your estate, and they would typically be subject to probate fees unless you've implemented some type of efficient estate planning, such as the dual will strategy that I mentioned earlier. So having a primary will that has most of your assets, and then a secondary will that has your business interests and maybe some highly valuable personal effects. And the secondary will again is not probated. It's important again to remember that secondary wills are not applicable in all provinces, but they are allowed in Ontario. So if there's the probate fees potentially payable, And then when it comes to income tax, there's also some thinking that needs to be done around the potential exposure to double taxation, which occurs when you have private company shares that were created on a nominal value. And if you've accumulated wealth in your corporation and they now have significantly increased in value, which hopefully is a happy problem, but that difference is going to be a capital gain that's deemed to be disposed and that's triggered on your passing. And then what happens is if you are the sole director of your corporation, your executor would take over as the sole director of your corporation, and they would typically need to deal with all aspects of the corporation, which includes disposition of assets from the corporation, which may trigger a second layer of tax. So I bring it up because it's important to think about and to plan for. Don't ask me any questions about private corporation shares. It's very complex. And I should mention that I'm certainly not a tax expert. So just preparing for Q&A time. Okay. So I'm going to move on and talk a little bit about how ClearEstate actually supports people with estate planning, which we always get a lot of questions about. So essentially the way that we operate is we have different packages to choose from based on what exactly your needs are and the complexity of your situation. But for most of our packages, you have a dedicated estate professional that guides you through the process. So we're there to kind of hold your hand and push you in the right direction. There's an intake of your personal assets. There's an intake of your personal and asset information. And once we have kind of a view of all your information, then there's guidance and coaching around the different information that you need that might be relevant to you. And then of course, there's the decision-making process where you actually finalize what you want in your estate plan. And then there's the generation of the necessary documents, which would be your will and your power of attorney. Then we would securely store all of this information in kind of a digital vault on our platform, and you have access to it and can update it over time as needed and as your circumstances change. Okay, so the next slide, I want to quickly talk about ClearEstate's professional services. We are able to, through an arrangement with a trust licensed partner, act as executor and agent in your estate settlement. So for any of you who either don't have an appropriate person you want to appoint, if anyone was at our last presentation, we talked about this, or you don't want to burden a family member, this is a potentially good option. And of course, the whole goal here is to alleviate that responsibility from your family members and your loved ones and make sure that everything is taken care of properly by a third-party professional who are impartial. We don't have opinions, we just kind of do the job and we do the job right. This can also make things easier if your loved ones live in other jurisdictions or if you have more complex planning needs. In terms of cost, we typically cost about 1/3 of what traditional trust companies charge. I think there's a pricing slide at the end, so I'll pull that up at the end so you can get a better idea of pricing. Okay, now I just want to highlight really quick some key takeaways before we go on to questions. The first thing is, of course, dying can be very, very expensive, and tax liabilities on death can be significant, especially without any planning. And so it's really important, I think, that you consider getting the right help and seek expert professional guidance so that you can properly consider any efficiencies that you can create and that your estate plan will happen as you intended. And then of course you can always revisit your plan regularly as your circumstances change. So making a will is and a power of attorney and an estate plan is really the first step, but it has to be updated regularly as well as your life changes, your circumstances changes. That's really important. Sorry, didn't click fast enough. Okay, so that's it from me. Mike, John, Ellie, anything to add before we get into the Q&A?
I guess the only thing I might maybe just quickly add before we get into some of the Q&A, there's a couple of things you had mentioned. One on the TFSA, just as a note to our clients, it's generally our practice that we name a successor holder. So that's kind of our common practice, unless your specific situation would suggest otherwise. The other one that you mentioned, and it comes up in a lot of conversations that we have with clients, is the ownership of bank accounts with an adult and their child, that happens a lot. Wanted to just bring forward, again, we've already had some conversations with a few clients, and there's probably more to happen, is there is a new CRA reporting requirement that's now come into place too. So if you happen to have a joint account, if it's an account for convenience purposes, if that account is worth more than $50,000, that now requires individual trust tax reporting. In fact, so the first year of that is for 2023. So CRA is kind of using 23 as a bit of an educational period of time to make sure people are aware of this new requirement. But that's something just to keep in mind, that if you have those joint arrangements, you might be having a bare trust relationship in place. That's something that might require some additional tax reporting. So again, if you want more information on that, you can reach out to either myself or Mike on that.
Thanks for that, John. That's actually tying into one of the questions we have already, which is, do Canadian banks have a way to distinguish joint account intentions? So
Yeah.
I think that's a pretty common question. Dana, do you have some info there?
So I think I mentioned a little bit about this before. So you can make an account joint with the right of survivorship, and then upon your death, it automatically goes to the surviving account holder. You can make it joint for convenience purposes, which may not have the survivorship on there. So sometimes the bank, and it's difficult because sometimes banks don't look too far into it, and they're just like, okay, this person has passed away, it automatically goes to this person, which is not always right. So I mentioned that according to the law, there may be a presumption of trust when a adult child is added to an account, but it's not with the right of survivorship. So there could be some angry family members there if the account does go to them. So it's really important to let the bank know your intention so that they can document it on the papers, so that when the joint account holder does pass away, it's very clear what your intentions were.
Wherever possible, be as clear as possible, because you won't be there to clarify what they should be doing, right?
Correct.
Okay. Thanks for that. And I encourage people, ask more questions. This is your chance. We have a few more minutes left. We did have some questions that came into the chat, actually. So let me go back over here. One question from a participant tonight is, if the home is only in my name and my husband is the beneficiary of all assets through my will, will probate be required on the home, assuming there are no other assets that would need to go through probate, as it's all registered plans with named beneficiaries?
Yeah, so that's a really good question, and sometimes you don't think that, you're like, well, everything's going to my husband, so of course there's not going to be any court process, there's not going to be probate fees. If the home is only in your name, it will have to go through probate unless it qualifies for that first dealings exemption, which is very rare. So it will have to go through probate regardless of whether there are other assets or not, and there will be probate fees applicable on it.
Okay.
So the way to avoid that is to have your husband as joint with the right of survivorship, or joint, join it with the right of survivorship on your home, or joint tenants. If you're registered as tenants in common, then 50% of that would have to be probated, because it would be a 50-50 split. So the title is very important.
Yeah. Okay, I hope that helped. Again, just being as clear as you can and planning ahead is going to be the right thing to do. Everybody has different situations, and I was just trying to get more information on Carmela's question about principal residences, and she followed it up with, well, what about secondary residence or a vacation property? Basically, you will be heartened to hear that I heard from 3 different experts from ClearEstate, because I typed this question into our Slack channel, and they all agreed that, well, what about, they had a lot of questions to qualify what their answer would be. So it's not really prudent for me to just give a one-size-fits-all answer for that. But the question for everybody, if you're getting lost, is if a value changes of a principal residence between the time of death and the day that it's sold, how can we make this advantageous tax-wise? And there are ways. It just depends, and there are different factors at play depending on who's living in the home. If nobody's living in the home, it isn't a principal residence anymore, et cetera, and so on. So there's a lot of things to consider.
Yeah, that's why I didn't want to give a quick answer.
Yes, and you were right to do that. I have another question here. For your primary residence and upon the death of your beneficiary, the value becomes part of your estate and may be subject to probate, but not capital gains. Correct?
Yeah.
I'm not sure if I understand that. Does anyone else?
I'm not sure that I do either. Do you mean the beneficiary of your estate or the because there's no beneficiary of a primary residence? Okay, upon the death of the beneficiary, the value becomes part of your estate and may be subject to probate, but not capital gains. Okay, so I think I understand. So your primary residence, when
I think
you
sorry, what they might be referring to is, is there capital gains? But as we know, there's a principal residence exemption. So you do not pay capital gains on your principal residence. It's only investment properties. So there would be no capital gains, but yes, there would be probate.
Yes.
And if you're saying like I might be reading this wrong, but I think that like when your principal residence passes to your beneficiary and then they pass away, is it subject to probate and capital gains? I'm not sure. That'll depend if it applies as your principal residence, but possibly.
He says thank you. It looks like we've answered this question.
Really trying to dissect that.
We're trying, Bob. Okay, a couple more questions just to finish up. We have, is there a legal obligation to state that it is an account of convenience if I want to add my adult children as co-owners of my bank accounts and I'm in non-registered accounts with right of survivorship?
Okay, I'm just gonna read that one. Is there a legal obligation to state that it's an account?
People cramming different ideas into one question.
Yeah, sorry. So there's no.
I think the answer is yes. I think if there's nothing to ever suggest it was. So if there's no notes to the bank's files, or if an account is opened up with myself or Mike or Carmela, again, we're generally going to document the purpose of that account. It's going to be very clear. And in some cases, it's followed up by how it's funded as well too. How was that account funded? In the sense of contributions to it, money going into it, and all that kind of stuff. So there is a few things that would come into that. So my experience is, and the other thing, and Dana, you mentioned it earlier, not all banks are going to recognize what might have been a conversation that happened 20 years ago when that account was opened. And some institutions just won't even open up that convenience account. It's either going to be a joint with right of survivorship, and you're really left on your own to kind of manage that expectation. It really is going to depend on the institution.
It does depend on the institution. Yeah, there's that as well.
I've done a lot of digging into people's transactions after they pass away to go with a joint account going, is this actually a joint account? Was that the intention? Whose money is going into the account? The mom's CPP, their OAS, their pension, and it's all of their deposits, and the child's not contributing to the account. There is a presumption of trust there. Yeah. It really does depend on the circumstances.
And the other thing that would be testing of that too is who's reporting all the income on the accounts as well too. So if it's an account where, again, it's mom's account, daughter's on it, if mom is basically reporting all the taxable income on it, the T3s, the T5s and all that, that's another sense to kind of show she was really the beneficial owner of that, versus again, to kind of, so there's a couple of things that will help, kind of set that situation up.
Mm-hmm. And last question is about minors. So if somebody, how are minors handled if you specify them as joint on an account? Can you have a joint account with a minor?
So I know with us, we cannot. So yeah, we would never find ourselves in that situation because legally you can't do that.
Normally you have to disclose like the birthday and that type of stuff, so you wouldn't have a joint owner. But if you have a will and you name a minor, because of course nobody's asking for birthdays and ages and that type of stuff. So in your will, if you leave money directly to a minor, that's a big issue. So it actually has to be held in a trust, and it can't go directly to the minor. And then there's a lot of complications involved in that. Another reason why estate planning is so important. And how things can get complicated after your death.
Yeah, so even with these questions that the people have kindly asked tonight, we don't have straightforward answers. So it really does pay to speak to your experts in your life. And Mike and John and Carmela are there for a lot of your questions. They were able to help us out tonight. Thank you so much. And of course, when it comes to planning your estate, planning is super important. Avoiding as much tax as you can is something to be discussed and something ClearEstate can do with you. So we hope to meet more of you soon. And thank you so much for joining us tonight. I'll turn it over to John to finish us off.
Thank you very much, Ellie. Thank you, Dana, for sharing with us your insights and thoughts on tonight's topic of estate planning. You did a good job in sharing with us how assets can be taxed upon the individual's death. You're also able to share with us, the big question of what is probate and how is it applicable, and also shared with us a couple of tax strategies to make your estate a bit more efficient. So thanks, Dana. Appreciate that. Also want to thank Ellie for setting this evening up. Ellie is our relationship manager with ClearEstate. We work closely with her. Our clients work also closely with Ellie as well too. So thanks, Ellie, for helping getting it all set up for tonight. This was the third installment of our educational series centered around the topic of estate planning. A replay of this recording, as Mike said, will be posted to our YouTube channel. We'll send an email out when that's ready, so in about a week's time. So if you want to look at this again or share this one with someone in your family or your friends, by all means, please do that. And then the other two previous topics were also on our YouTube channel. Knowing this is an important topic, again, tonight's participation shows it. We had a very large participation event tonight. We're doing another estate planning session on May 8th, and the topic of that will be estate expenses, fees, and again, a little bit more on taxes. We'll get a bit more granular as well too. So watch for an invite and a save the date for the May 8th event that will take place. Finally, I just want to thank our clients and their families who've attended this evening's presentation. We'll remind you, if you have any questions on this, you can reach out to myself, Mike, or Camilla. Again, if we don't know the answer, we have the ability to get those answers for you either through ClearEstates or some of our other professionals that we deal with on the tax side. And on that note, I'd like to wish everyone a good evening, and thank you very much for attending.
Thank you.